Let's just dive right in. Okay, so here's our roadmap for today. We're breaking things down into 6 core sections. Journal basics, the rules of debit and credit, Priya's real-world transactions, using special journal books, adjustments and closing entries, and finally, fixing errors and the cycle.
Section 1. The Accounting Journal Basics.
To kick things off, I want you to meet Aarav. He's a really curious commerce student, and he asks a perfectly logical question. Why can't I just, remember my transactions? Well, to answer that, we bring in Ravi, our expert accountant. And Ravi has this brilliant analogy. Think about your phone's UPI transaction history for a second. Every single time you scan a QR code and pay, your app automatically records exactly who you paid, how much, and exactly when you did it, right? A business journal does the exact same thing. It gives you a foolproof, chronological record so literally nothing gets lost or forgotten. The only difference, you're writing each entry manually.
Now, take a look at this. It's the rigid, yet honestly kind of elegant, 5-column format of every single journal entry. It's a lot like your WhatsApp chat history. Just like every text has a timestamp, every transaction here has a date. Then you have the particulars column, and this is where the story actually happens. It shows exactly which accounts are involved. After that is LF, which stands for Ledger Folio. Don't let the fancy name scare you, it's basically just a page number reference. And finally, the absolute heartbeat of accounting, the debit and credit amount columns. Every single financial event gets logged right here.
Moving on to Section 2, Rules of Debit and Credit.
Okay, so mastering these rules is kind of like learning the laws of physics for a business. Once you get this, you can record absolutely any transaction on the planet. Accountants use what they call the 3 golden rules to figure out what goes in the left column, the debit, and what goes in the right column, the credit. First up, for personal accounts, like people or businesses, you debit the receiver and credit the giver. Second, for real accounts, things like cash or laptops, debit what comes in, credit what goes out. And third, for nominal accounts, debit all expenses and losses, and credit all incomes and gains. It's really that simple.
And this right here is your ultimate cheat sheet. If you ever find yourself getting confused, just look at this master reference table. The absolutely crucial point to remember is this. Assets and expenses are normal debit accounts, so when they go up, you debit them. On the flip side, liabilities, equity, and revenue are normal credit accounts. When they go up, you credit them. This whole structure is designed to make sure that the fundamental accounting equation, assets equal liabilities plus equity, always stays perfectly balanced. Your total debits will always, magically, equal your total credits.
Section 3, Priya's real-world transactions. Let's see this in action.
We're going to pull these abstract rules into reality by following Priya, who is opening up a local clothing shop. It's day 1, June 1st, 2025. Priya takes 200,000 rupees out of her personal savings to start the shop. So let's apply our rules. Cash is an asset that's coming into the business, right? So we debit the cash account for 200,000 rupees. And where did that cash come from? The owner. So we credit the capital account for 200,000. Also notice that brief little note at the bottom in brackets? That is called the narration, and it just quickly explains exactly what just happened.
Fast forward a few days. Priya needs to pay her shop rent, which is 5,000 rupees, and she pays it in cash. Now, rent is an expense, and if we look back at our golden rules, we always debit expenses. So, the rent account gets a debit of 5,000, and since cash is going out of the business to pay for that rent, the cash account gets a credit of 5,000. Do you see how logical this flow is?
Now let's look at something a bit different. A credit sale. Priya sells 18,000 rupees worth of clothes to a customer named Meena, but Meena promises to pay her later. So no cash is actually changing hands today. But Meena is the receiver of the goods, so we debit Meena's account. And on the flip side of that, sales are an income for the shop, so we credit the sales account.
Okay, so 3 days later, Meena comes back to settle her tab. What's coming in? Cash. So we debit the cash account for 18,000 rupees. And who is the giver of this cash? Meena. So we credit Meena's account for 18,000. This entry perfectly cancels out the debt that Meena owed from that previous slide, completely closing the loop on that specific transaction. Now, running a business is hard work, and sometimes the owner needs a little bit of cash for themselves. On June 27th, Priya takes 5,000 rupees out of the shop's register for her own personal use. In accounting, we have a special name for this, drawings. We debit the drawings account to show this withdrawal of equity, and since cash is physically leaving the business, we credit the cash account.
All right, Section 4, Using Special Journal Books.
As Priya's shop gets more popular and starts booming, writing down hundreds of repetitive, similar entries in one giant diary becomes wildly inefficient very fast. To solve this, accountants use what are called subsidiary books. Think of these like fast-track lanes for grouping similar transactions. Instead of logging 50 separate credit sales in the main journal, they all just go straight into the sales journal. All credit purchases, they go into the purchase journal. But the absolute most popular one is the cash book, which completely takes over recording every single cash and bank transaction. It's great because it keeps the main journal completely clean and uncluttered.
Section 5, Adjustments and Closing Entries.
At this point, our student Aarav asks another really great question. What do I do at the end of the year? Do I just stop recording? Well, not quite. Accountants have to capture these sorts of hidden realities using adjusting entries. For example, imagine Priya's staff earned their salary in the last half of June, but Priya isn't actually going to hand them the cash until July. That expense still rightfully belongs to June, so we have to write an adjusting entry. We debit the salary account to formally record the expense, and we credit a liability account called salary payable because she legally owes that money. This makes sure the books are perfectly accurate to reality.
And then comes the grand finale of the accounting year, closing entries. Look, you can't start a brand new year with last year's sales numbers still stuck on the scoreboard, right? You have to reset temporary accounts, like your incomes and expenses, back to zero. To do this, we forcefully empty them. Here, we debit the sales account for its total balance of $150,000, and we transfer that balance by crediting the final trading account. Boom! The scoreboard is wiped clean for the new year. Finally, Section 6, Fixing Errors and the Cycle.
Let's be real. Humans make mistakes, and accountants are definitely human. There are a few classic blunders you'll probably encounter. First is an error of omission, which is exactly what it sounds like. You completely forget to record a transaction. Then there's an error of commission, which is when you write the right account but the totally wrong number, like writing 500 instead of 5,000. And lastly, an error of principle. This is a category error, like accidentally logging a routine repair expense as a permanent capital asset.
Now, if you make a mistake, your beginner instinct might be to just grab an eraser or hit the backspace key. But Ravi has a very strict professional rule. In accounting, we never, ever erase. Erasing looks suspicious, it looks like fraud. Instead, what we do is write a transparent rectification entry. This is a brand new separate entry that essentially reverses your mistake and fixes the balance. It leaves a clear, totally honest paper trail of exactly what happened and how you fixed it.
Let's see how this actually works in practice to fix an error of principle. Let's say someone accidentally charged a 3,000 rupee repair bill to the machinery asset account. To fix it transparently, we write our rectification entry. We correctly debit the repairs account to properly log the expense, and we credit the machinery account to subtract that 3,000 right back out of it. Error fixed and trust maintained.
Okay, to wrap all of this up, let's zoom out for a second and look at the entire four-step accounting cycle. Everything starts exactly where we've been spending our time today, the chronological journal entries. From there, all those numbers get sorted into the ledger. At month end, they're summarized into a trial balance just to double check that your debits actually equal your credits. And finally, at year end, they flow into your final accounts, like the balance sheet.
And there you have it. We took the complex language of business and broke it right down. You now understand the basic journal, the 3 golden rules, how to handle real-world shop transactions, and even how to close out the year and fix mistakes like a pro. But hey, this is just step 1. You've mastered the journal, but are you ready to post to the ledger? Keep reviewing these concepts, check out the glossary and the source text, and above all, stay curious. We'll see you on the next